It happens at every point in the business cycle. Whenever you have a monetary system based on debt, if you stop growing that debt, you will crash. Right? That's exactly what happened back in 1929 and 1873. And was it 1850, 1858, or this happened all the time in the 19th century and the 20th century. This is just the latest version of it, but it just keeps getting more modernized. But it's the same concept. You have to people get into more and more and more debt, and then when you buy more and more stuff, you look richer and richer and richer, but you're actually poorer and poorer and poorer. When that poverty is revealed, it's like all of a sudden nobody has anything.
Financial analyst Rafi Farber reports that the Federal Reserve's ongoing quantitative tightening is causing a significant drop in bank reserves, echoing patterns seen in past financial crises. As the Fed reduces its balance sheet, reserves have fallen sharply, raising concerns about financial stability. Despite high interest rates around 5.5%, the economy has not yet faced a severe downturn. However, Farber notes that banks are under pressure due to holding low-interest mortgages, which yield lower returns in the current high-interest environment. This discrepancy increases operational costs and the risk of defaults. The reduction in bank reserves and rising interest rates could trigger a banking crisis. Farber warns that declining pending home sales add to these concerns, potentially leading to a broader economic recession with banks at the center. Globally, the stability of the Japanese yen is crucial. Japan's significant holdings of US treasuries mean a yen collapse could have far-reaching effects. Farber suggests that investing in precious metals like gold, silver, and platinum could be a safeguard against inflation and economic instability. But before we proceed, please remember to show your appreciation for this video by giving it a thumbs up, and make sure you're subscribed to TM Views for more insightful content. And turn on the notification bell so you don't miss future videos. Now let's continue with the video speaking.
The dollar would be the last currency to fall. And from a strict pyramidal perspective, with the dollar on the bottom of the pyramid and right under that gold and silver, then yeah, like everything would flow into the dollar. And like, in a sense, you could see how that makes logical sense, because when let's say a Venezuela or Argentina, when their currency dies, they go to the dollar. When anyone's currency dies, they go to the dollar. They dollarize, right? Everybody does that because the dollar is the base of the pyramid. So that's what you do. And you need liquidity, so you need a currency system. You need a division of labor. That's what you do. So on that basis, just looking at that perspective, then yeah, the dollar would be the base of the pyramid. It would be the last currency to fail. But here's the thing. Now, if Argentina fails, or Zimbabwe fails, or Venezuela fails, or some third world country somewhere, right? They're not a very integral part of the Keynesian system. They're a part of it. They're somewhere in the pyramid, but they're very, very minor. Even Argentina, which is like a G20, and you could say that it's a respectable economy, at least when it's functioning, it's still not very big. But then you think about, like, what about Japan, right? This isn't just a pyramid. Right? This is like a hyper pyramid, 4-dimensional, whatever. I mean, I'm just, I took a class once on these multi-dimensions. They showed us a hypercube and how it moves in the fourth dimension. So, try to imagine a fourth dimensional pyramid, and you have Japan here, and they've taken the bottom of the pyramid and they've like stuffed it into their own thing by buying all these treasuries. So what happens to Japan if the yen falls, right? They go to the dollar. I mean, they already own $1.5 trillion in treasuries. So what happens when one of those countries that has its hand like right in the bottom of the pyramid itself with all the treasuries that it owns? What happens when its currency fails? So then you have like some kind of like pull from the middle. I mean, I can't even describe what it's going to be, but we've never been in a situation where a country with major holdings in the dollar itself has a currency problem, right? That's a whole new problem for this pyramid or hyperpyramid or however the hell you want to describe it. I don't even know anymore. We've just never seen it before. So we could be just to think through it logically. If the yen really starts hyperinflating, right? It's like 161 now. So what if like tomorrow it opens up? I'm not saying it's gonna happen, but what if theoretically tomorrow it opens up at 200 and then it goes to 240 by the end of the day? What is Japan supposed to do? Right? The only thing they can do is dump all the treasuries on the market. They can't do this either because it would destroy everything. You see what I'm saying? So if we head into a situation where the yen really is hyperinflating, you've got $1.5 trillion in treasuries, or however much it is, 1.1 trillion. It's over $1 trillion. You have all those dollars in treasuries. that are vulnerable, and you got to do something with them to save the yen or not save the yen. And then what happens? Then all the trade with Japan, that's part of the trade cycle of this whole Keynesian nightmare, falls out of the loop. And then what happens then? I don't know. It's not good, but it's a lot worse than Argentina or Zimbabwe.
Silver prices hit a 3-week high on optimism over a potential Federal Reserve rate cut, rising 6% in July. The prices have extended their winning streak for the 8th consecutive trading session, reaching Rs 92255 per kilo on the MCX. This rally is driven by softer than expected US economic data, which has reinforced expectations for a Fed interest rate cut. Markets are anticipating a rate cut in September due to waning inflation, a slump in the US job market, and a cooling economy, with traders pricing in a 73% chance of this outcome, according to the CME FedWatch tool. During periods of falling interest rates, gold prices typically rise as investors find bullion more attractive compared to income-paying assets like bonds. The US PCE index showed that inflation in May slowed to its lowest annual rate in over 3 years, with core PCE prices increasing by only 0.1% from the previous month, the smallest increase in 6 months, and the annual rate easing to 2.6%, the lowest since early 2021. Additionally, US job openings rose to 8.14 million in May, and first-time applications for unemployment benefits increased last week, with the number of people on jobless rolls rising to a new high by the end of June.
It's not something that I look at, and it's not really a market outside of money that I understand so much. I do know that I've read in When Money Dies and stories of the German hyperinflation, people were also hoarding platinum. It was a thing because they were trying to preserve their wealth. I mean, gold and silver were primary, but platinum is secondary. I mean, in my thinking, there's no such thing as an objective money. There's degrees of liquidity among commodities, right? And the most liquid one will be money. If you're in a prison, it'll be tuna cans or mackerel cans. If it's Virginia in the 18th century, it'll be the most liquid commodity, which was tobacco back then, because they didn't have enough gold or silver to base an economy on it. Whatever, it's always the most liquid commodity. So platinum is never the most liquid commodity, so it's never going to be the money. But as commodities go, it's pretty damn liquid, right? It's much more volatile than gold and silver, but it's much less volatile than, oil or wheat or something. Maybe it isn't. It's a better money than wheat and oil because oil burns and you can't really carry it. But okay, we all know this. What I noticed was that when someone came to my house and wanted some silver for a platinum coin he wanted to give me, so I just looked at the ratio and I was 34. I just calculated. I didn't look at a chart, and it was 34. So I gave him 34 ounces of silver. He gave me a platinum coin. It was fun, and it was my first platinum coin ever. I never had one. So I didn't want to import one because all these taxes and it's annoying. So and then I looked at the chart, zoomed out, and I was like 34. Well, that's an all-time low, except for 1980. And then I looked at gold. Well, the gold to platinum ratio is at an all-time low. And for 100 years, from like 1910 to 2015, 105 years, the platinum has always been more expensive than gold, almost always. And then all of a sudden in 2015, something changed. Now we could speculate as to why, but the point is, if you've got a lot of silver, and it's bulky, and you don't, and it's making you a little bit nervous because how are you going to move it? Which is a situation that I'm in personally, because I might have to evacuate. Again, we were talking before that this was a particularly bad day for the north in Israel. Here we had like 5 or 6 fires around, and everything smells like barbecue. Nobody was hurt, but things are burned. So I don't know. Maybe I'll have to take my stacks and just run away. I don't know. So it'll be easier to do that with platinum than it is with silver, though silver is much more liquid. So the thing is, if you've always wanted platinum, I wouldn't say start stacking platinum. That's not responsible. But if you've always wanted some, I think now is a very good time to do it, because if you trade some of your silver for platinum, it's very cheap. I think it's like 32 ounces now. It's even lower than when I got it.